If you're retired or getting close to it, what the IRS just put out could quietly change how much you owe next spring, and in some cases, how much you get to keep. I'm talking about brand new taxpayer guidance that landed recently, and it touches everything from how your Social Security gets taxed to what counts as income in retirement, plus a few wrinkles that almost nobody is talking about yet. The IRS released updated guidance that clarifies, and in a few places adjusts, how certain retirement income and benefits are treated for tax purposes. Now, this isn't some sweeping overhaul of the tax code. Congress didn't pass a new law last week. But what the IRS did is issue official instructions that affect how you report income, what deductions you might still be eligible for, and how some popular retirement strategies interact with current rules. One of the biggest areas this touches is the taxation of Social Security benefits. Most retirees know that if your income crosses certain thresholds, up to 85% of your Social Security becomes taxable. What fewer people realize is that the IRS just clarified how some lump sum distributions, required minimum distributions, and even certain annuity payments factor into those calculations. It's not that the math itself changed. It's that the IRS is now telling preparers, and you, exactly how to handle situations that used to sit in a grey area. And grey areas, in tax world, are where mistakes happen. Say you're 72, you've got a traditional IRA, and you took your RMD last December. You also started a small part-time consulting gig to stay busy, and you're collecting Social Security. On paper, you might think your combined income is one number, but depending on how that RMD was calculated, whether you took it as a lump or spread it, and how the IRS now wants certain items reported, your actual taxable Social Security could end up higher than you expected. That's not a scare tactic. That's exactly the kind of scenario this new guidance addresses. Another angle in this guidance involves the standard deduction and what the IRS calls above-the-line adjustments. For retirees who are no longer itemizing, and that's most of you, the standard deduction is your best friend. But the new guidance tightens up some reporting requirements around things like charitable distributions from IRAs, also known as QCDs. If you're 70 and a half or older and you give to charity directly from your IRA, that distribution can satisfy your RMD, and it doesn't count as taxable income. That's still the rule. But the IRS is now asking for more specific documentation, and they've clarified that if you mess up the timing or the reporting, you could lose the benefit. So if you're doing QCDs or thinking about it, double-check your paperwork. The strategy still works beautifully. The IRS just wants to see it done by the book. Did you know that some state tax refunds you received last year might actually need to be reported as income this year, even if you didn't itemize? It's one of those oddball rules that's been around forever, but the new guidance includes a fresh example specifically for retirees who get both a state pension and a state tax refund. If your state pension was partially taxable and you got a refund related to it, a slice of that refund could be income to you now. Most people assume refunds are free money, and this is exactly the kind of detail that separates a smooth tax season from one where you're writing an unexpected check in April. I'm over 65, so I don't have to pay taxes on my investment income. There is no age-based exemption for capital gains, dividends, or interest. The new IRS guidance doesn't change that, but it does include updated examples showing how retirees with modest pensions but healthy brokerage accounts can still end up with a tax bill. In fact, because the capital gains rates are tied to your overall taxable income, a retiree with $40,000 in pension income and $30,000 in long-term gains might pay zero federal tax on those gains, while another retiree with the same pension but $50,000 in gains could owe thousands. It's all about where you land in the brackets. The guidance walks through these scenarios with fresh numbers, and if you're managing your own withdrawals, it's worth looking at where your income sits. If your only income is Social Security and a small savings account, honestly, not much here changes for you. Your filing is likely still simple. But if you have multiple income streams, Social Security, a pension, IRA withdrawals, maybe some rental income or part-time wages. This guidance is written with your situation in mind. The IRS is essentially saying, we know retirees are more financially complex than they used to be, and here's how we want you to report it. That complexity is a double-edged sword. It gives you more opportunities to plan. Some retirees take an early distribution from a 401k or IRA, thinking the 10% penalty doesn't apply after a certain age. The early withdrawal penalty goes away at 59 and a half, not 59, not 60, 59 and a half. The new guidance includes a stern reminder to preparers that the IRS is watching these ages closely, and they've added examples of what counts as a valid exception. Things like substantially equal periodic payments, certain medical expenses, and first-time home purchases, but with very specific limits. If you're thinking about tapping retirement money early, don't guess. The penalty is 10% on top of ordinary income tax, and on a $20,000 withdrawal, that's $2,000 you're just giving away. The interaction between Medicare premiums and your tax return. Most retirees know that Medicare Part B and Part D premiums are income-related. What they don't always connect is that the IRS shares your tax return data with Social Security, and Social Security adjusts your Medicare premiums 2 years down the line based on your modified adjusted gross income. So the moves you make this tax year, how much you convert to Roth, how big your RMD is, whether you realize capital gains, those don't just affect this April. They affect what you pay for Medicare in 2027. The new guidance doesn't change that linkage, but it does include updated income brackets for the income-related monthly adjustment amounts, or IRMAA. Those brackets are not fully inflation-adjusted in the way people assume. A small raise in your income can push you into a higher Medicare bracket, and suddenly you're paying hundreds more per month. It's a 2-year lag, which makes it easy to forget, but it's one of the most expensive forgets in retirement planning. One of the best takeaways from this guidance is a renewed emphasis on tax withholding. The IRS updated its withholding estimator tools and included new guidance specifically for retirees who have pension income, Social Security, and IRA distributions. People set their withholding once when they retire and never look at it again. But if you started taking larger distributions, if your pension changed, if you started a part-time job, your withholding is probably wrong. And being under-withheld by even a few $100s per quarter can lead to an underpayment penalty, even if you owe nothing when you file. The guidance encourages retirees to do a mid-year withholding checkup. Not in December when it's too late, in June or July. That way you can adjust your W-4P for pensions or your voluntary withholding for Social Security and IRAs. If you're still working in retirement, and more people are than ever before, you might be able to delay taking RMDs from your current employer's 401k plan. The rule says if you're less than 5% owner of the company and you're still employed, you don't have to take RMDs from that specific plan until you actually retire. This does not apply to IRAs. It does not apply to old 401ks from previous employers. But if you rolled everything into your current employer's plan and you're still working at 73 or 74, you could legally delay those distributions. That's a huge planning opportunity, and the IRS just refreshed the examples to make it clearer. Most retirees have never heard of this. Their accountants might not even bring it up unless asked. So ask. If I give money to my grandkids, I can write it off. No. Gifts to individuals are not tax deductible. Never have been. The new guidance includes a reminder about gift tax rules, and here's where it gets interesting for retirees. You can give up to $18,000 per person per year, that's the annual exclusion for 2024, without touching your lifetime exemption. Give more than that, and you have to file a gift tax return. Payments made directly to a medical provider or educational institution for someone else's benefit don't count toward that limit at all. So if you want to help a grandchild with tuition or a medical bill, pay the school or the hospital directly. The IRS guidance includes a fresh example of this, and it's one of the cleanest ways to transfer wealth without paperwork or tax consequences. Now, I want to circle back to something I mentioned earlier and really dig into it, because this is one of the most valuable pieces of the new guidance, and I saved it for those of you who stuck around. The IRS clarified how the net investment income tax interacts with retirement income. This is a 3.8% tax that hits when your modified adjusted gross income exceeds $200,000 for single filers or $250,000 for married couples filing jointly. It was designed to hit high earners with investment income. Large Roth conversions, big RMDs, or even the sale of a second home can push your MAGI over those thresholds. And once you're over, not only is your investment income hit with the extra tax, but the income that pushed you over is taxed at ordinary rates too. The new guidance walks through a retiree example where a $100,000 Roth conversion triggered over $5,000 in net investment income tax that the person never saw coming. If you're providing more than half the support for a parent, a sibling, or even an adult child, you might be able to claim them as a dependent. The new guidance updates the income limits and support tests for 2024. The person you're supporting generally can't have gross income over $4,700, though Social Security usually doesn't count toward that if it's their only income. But if they have a small pension, interest, or part-time wages, they might cross that line without realizing it. And if they do, you lose the dependency exemption, which also affects your eligibility for head of household status and certain credits. It's worth having the conversation now, before tax season, to see where everyone stands. The IRS guidance encourages retirees to create an online account at irs.gov if they haven't already, not just to check your refund. You can view your tax transcripts, see what the IRS has on file for your income, verify your estimated payments were credited, and catch identity theft early. In the new guidance, the IRS specifically notes that retirees are increasingly targeted by scammers who file fake returns in their names. An online account lets you see if a return was filed before you even get your documents together. It takes 15 minutes to set up. You'll need a phone, an email, and some personal information. Imagine a married couple, both 74. He has a pension and Social Security. She has a smaller Social Security check and a rollover IRA. They're comfortable. They decide to sell their vacation cabin to simplify things. The cabin has a big capital gain because they've owned it for 30 years. They also decide to do a Roth conversion this year because they heard it's smart. And they bump up their charitable giving through QCDs from her IRA. Individually, each of these decisions makes sense. But stacked together in the same tax year, their MAGI skyrockets. Their Medicare premiums jump 2 years later. They hit the net investment income tax. A chunk of their Social Security becomes taxable that wasn't before. And they might even lose some deductions due to phase-outs. The new guidance is full of examples like this. Not to scare you, but to show how one good decision can have ripple effects if you don't look at the whole board. That's why tax planning in retirement isn't about one move. The IRS released updated guidance that affects how retirees report income, calculate taxable Social Security, handle RMDs and QCDs, manage withholding, and avoid penalties and surprise taxes. It's not a new law, but it changes how the rules are applied, and that matters just as much when you're filing. If you have multiple income streams, if you're working part-time, if you're doing Roth conversions, if you're selling property, or if you're simply trying to keep more of what